Investing in the stock market can be a great way to increase your wealth and reach long-term financial goals. However, there are many common mistakes that beginner investors make that can cost a lot of money, from buying the wrong stocks to neglecting research or failing to diversify a portfolio. This guide will go over some of the most common mistakes investors make as they start out in the world of investing. Also, stay till the very end to learn and avoid risking your money from next time. Being emotional. Well said by Warren Buffett. Be fearful when others are greedy, and greedy when others are fearful. Emotional investing mistakes can be some of the most costly. When markets are falling and the value of your investment is going down, it can be hard to keep your emotions in check. You have to be ready for hard times and not let them keep you from your financial goals. Waiting to invest. You'll never find the right time to start investing if you wait for it. It just doesn't exist. As long as you are playing the long game, the earlier you start investing, the better. When you look at markets over a long period of time, they have gone up more often than they have gone down. That means you want to keep a position in the markets for as long as possible. Lack of patience. Investing is not a quick way to make a lot of money. Some of the worst investments are made because people don't have enough patience. Get used to the idea that you might have to give up something in the short term in order to make money in the long term. Before we proceed, I would just like to ask you guys to please like this video, subscribe if you haven't already, so we can keep making videos like this for you guys. So, let's get on with the video. Top investing tips from the wrong place. Be careful about what you watch on social media and YouTube. You should do your own research so that you know what you're buying and why. Or, if you would rather have someone else invest for you, you can get professional financial advice from a qualified and regulated financial advisor. Don't listen to the guy at the bar or the people twerking in TikTok if they tell you how to invest your money. Chasing trends and buying past performance. The past is not an excellent way to predict the future. Not only is that a rule, but it's also the truth. Even if a stock, investment style, or asset class did well last year, that doesn't mean it will do well this year as well. You need to spend some time doing your research. If you're interested in investing in a certain area, look at how much growth the market is already pricing in. When it comes to individual companies, it's probably too late to invest if you hear about a great stock that has jumped 100% in price in a short amount of time and is getting a lot of hype. The best way to make money on investments are to buy valuable things before they become popular and sell them when they are popular for more money. Not diversifying. If you don't diversify, you're taking more risk than someone who is diversified. Invest in different companies, industries, and parts of the world. The more different kinds of investments you have, the safer you will be if something bad happens to one of them. This makes investing much less stressful as well. Overestimating your ability. Assuming you are a good investor is a dangerous way to think, especially if you are just starting out and don't have a track record to show for it. Most people make this mistake when prices are going up overall, which is when the stock market is at its best for us. During a bull market, investors may feel like they can't lose and may think they are better at investing than they really are. Even though it's easy to overlook this mistake when the market is going up, when a bear market starts, this mistake can be a new investor's downfall. Thinking you need to be rich to invest. To get started, you don't need a lot of money. This is one of the simplest investing mistakes to avoid. With most of the commonly trading apps, you can start investing with as little as $5 or less, so you don't have to wait until you have more money to get started. Every investor has to start somewhere, and the best time to start is almost always now. Thanks to the power of no commissions and fractional shares, investing over time and getting interest that keeps growing is a powerful thing. At 5% growth per year, $50 invested every month for 30 years can grow to over $40,000. Not having an emergency fund. Before you invest, you should try to save enough money to cover your basic needs for 3 to 6 months. This should be in a checking account or an account where you can get the money quickly if you need it. So if your boiler breaks or your car breaks down, you won't have to sell some of your investments to pay for the repairs. The emergency funds acts as a safety cushion between your daily needs and your long-term goals. This should be a big part of how you plan before you invest. Not knowing your investing goals. You need to take time to figure out who you are, what you want and what you need. Know what you're putting your money into. You're not doing it just to make money. What's important is what the extra money could mean to you and what it could do for you. Putting money away for your retirement is a good example. A good plan for investing lets you buy the most valuable thing of all: time. An extra income can give you the flexibility to choose when you work and when you stop working altogether and retire. When you have a clear goal like this, you are much more likely to stick to it. Your goal must be to figure out how much you need and by when. Investing money you need in the short term. If you have extra money to invest but need the money back in 5 years, don't invest it. Who knows what will happen to the market in 5 years? Short-term market performance can be affected by a lot of unknowns. Putting money away for a big purchase in the next few years is more like saving than investing. It is important to not mix the two up. Savings should be kept safe so that they can be used when they are needed. Investments can be riskier, which is why you need to look at them over a longer period of time. Constantly watching markets. Too much information can make you want to mess with your investments. Things are always changing, and there is always more news. But most of the time, this won't change a sensible long-term investment thesis. If your investment goals are for the long term, it usually doesn't make sense to change them because of short-term changes. If you plan to invest for 5 to 25 years, you don't need to check on your investments every 5 minutes. Would it make sense to keep track of your distance in quarter-mile increments if you were running a marathon? Not understanding what you bought. Peter Lynch, a famous investor, said that if you can't tell a 10-year-old in less than 2 minutes what you own, it's a mistake. You need to know why you want to invest in something before you do. Once you know how an investment works, you'll have the confidence to keep it for a long time or sell it if things change. Chasing returns. One of the most common investing and trading mistakes is to choose a stock based on how much money it could make in short term. Always keep in mind that stock prices move in cycles. They go through their own ups and downs. If you invest in a stock or equity fund because it gives you a high return at a certain time, that doesn't mean it's always the right investment. It could be a short-term rise. You need to learn about the company, including its goals for growth, business model, management, and other things. Often, a company that fails in one or more of these areas may still have a high current price value. Chasing returns is equivalent to blind investing. One of the best ways to become a good investor is to learn from what other people do wrong. By knowing about common investor mistakes, you can avoid making them yourself and increase your chances of reaching your investment goals. Some of the most common mistakes investors make are not diversifying their portfolios, chasing after hot stocks, and letting their feelings affect their decisions. By knowing about these problems, you can avoid them and make it easier for yourself to succeed. Even the best investors do make mistakes now and then. Learn from your mistakes and move on.